Welcome, ladies and gentlemen, to our program. So this is just a continuation on what is the economy. So today we're going to look at the inflation and the purchasing power. So it is like the government versus people or the consumers. So whenever I say people, it's all about consumers or the buyers. So in the case of inflation and the purchasing power, we're going to look at the definition of inflation. So that'll be like section 1. Section 2, I'm going to divide it with on the purchasing power. I'm going to touch then section 3. It will be based on the practical examples between the inflation and the purchasing power. So the first one will be like the daily consumer goods, the first practical example. The second will be on the saving and the investments, the benefit of saving or the benefit of investment, which one is better. The third point, it will be based on the wages and inflation. The fourth one, it will be on the housing market. The fifth one, it will be based on the international travel, like traveling abroad, different countries. Then I'm going to show the effects of inflation on different economic actors or different sectors. Then I'm going to touch on the hyperinflation as well, and deflation and the stagflation. Stagflation is like the combination of a stagnation and inflation. So in this side, you have like high inflation with a stagnant economic growth. Then after that, I'm going to give a quick summary at the end, just as we usually do, just to sum up really whatever we start. So are you ready, ladies and gentlemen? Tighten your belt and let's begin. So what is inflation? What is the purchasing power? Government versus people. So in the case of inflation, so inflation is the rate at which like the general price level of goods and services in an economy increases over time. So it's the increase of price of a given time or specific period, something like that. So as inflation rises, when it goes up, the value of money decreases because the same amount of money buys only fewer goods and services as well. So we have the goods and services. We say the goods are like the tangible, the physical things. Services are like intangible things, the things which you cannot touch, which you cannot see, just online, just happen online or through the phone. So this is why inflation is often described as silent tax on consumers. So there's a joke as well on the tax. So it says like a fine is a tax for doing wrong. So you get fined if you do wrong, that will be called a fine. But a tax is a fine for doing well. So even if you do well, you still have to pay tax. That's why the little joke there. So in this case, we can see like the inflation is inversely proportional to value or price. The higher the inflation, the lower the price, and the money is more likely to lose its value. So we're going to look at the two types of inflation as well, divided into two types. The first one is like the demand pull inflation. So it occurs when demand for goods and services exceeds supply, when the demand is greater than supply. So these imbalances cause prices to rise or to go up. So a quick example of that, because I like to be practical all the time. So just to explore the imaginative side as well. So during like an economic boom, so in this case, you have like high wages or high salaries. Like when employment is high as well, consumers have more disposable income. So they have more disposable income, like they have more income really maybe in the money in the pocket. So leading like to an increased demand for products. Like this high demand pushes prices also to go upward, like to rise, to increase. The second type of inflation is like the cost push inflation. So it happens when like production costs, like let's say wages or raw materials. So these are like unprocessed materials, increasing, like when the raw material or wages increases as well, it causes businesses also to raise their prices to maintain profit margins. So in this case, the higher your wage or the higher your salary goes, the higher the price also will go up. So in this case, even if you get more salary or high wages, it's still useless, because the more the salary you get like at your job or at your employment, the higher the goods also will go up, like the price will go up, because they'll try to balance the high salary have to match with the goods or the groceries which you buy like in the shops. That's how they usually try to balance that, just to keep the inflation in the equilibrium or balanced. So a quick example of the cost push inflation as well is like if oil prices like rise, like due to geopolitical tensions, like transportation and production cost also will increase. So they have to be proportional, directly proportional, like leading to higher prices for goods that rely on oil. In this case, it is like the crude oil, such as gasoline and plastic as well. Like we're going to look at the section 2, the purchasing power. This will be like our section 2. So purchasing power refers to the amount of goods or services that one unit of currency can buy. So this is the definition of pricing, the purchasing power. So it's just the amount of goods or services that one unit of currency can buy at that time. So when inflation occurs, the purchasing power of money declines because rising prices reduce the quality or the supply or the quantity, which is the supply of goods or services that can be purchased with the same amount of money. So in the previous video, it was just all like on the supply and demand. So we're focusing on the quantity, not the quality. So a quick example of purchasing power, it would be like if a loaf of bread. So in this case, in the example of purchasing power, like let's say if a loaf of bread, like it costs, let's say 2 euros. I'm going to use euro, no pound or dollar. So today, like if it costs 2 euros today, and the inflation causes the price to rise, let's say at 2.50 euros, €2.50 in a year, like your 2 euro will no longer be sufficient like to buy the same loaf of bread. So this reflects a loss in purchasing power. So the bread was like at 2 euro, now the prices goes up, the 50 cent increase, now it becomes 2 euro and the 50 cent a year. So if the price of the inflation goes up, then the purchasing power also is going to lose its value, or the power, the consumer is going to lose the power to discourage the consumer really to keep buying more bread. So the consumer is affected here and the seller more happy because they're getting the profit, the 50 euro increase. So the practical example of inflation as well, this will be like the section 3. So we're going to get more into practical examples of inflation and its impact on the purchasing power. So in the case of purchasing power, it is all based on the consumer, and the government, they're the ones who control the inflation, or they're the ones who use the mechanism to increase the interest rate or decrease it, operating demand as well. So the first example to be based like on the daily consumer goods. A quick example of that, it would be, let's say, in a year of high inflation, like everyday items like let's say groceries, gas and clothing become more expensive. So if the inflation is higher, the daily things like the gas, groceries and clothing, everything, the prices goes up, become more expensive. So if inflation, let's say, is at 5%, a basket of groceries that cost, let's say, 100 euros today might cost 105 euros next year. So you add the 5%, the 5 euro on the top of that. So it becomes 105 euros instead of 100 euros. So that would be like the next year, the price skyrocket. So even though the price difference seems smaller, like even though it seems small, like over time, this reduces how much consumers can buy with the same income, like diminishing their purchasing power. So it discourages really, because instead of buying it at 100 euros, you have to add the 5 euro also to make it 105. So we're going to look at number 2, saving and investments. So in the case I said saving is much better than spending, but investment is far better than saving and expending at the same time. So saving and investment, a quick example of that. So let's say you have, let's say 100k or 110,000 euros, so 10k in a saving account, let's say earning like a 2% interest rate or interest, but inflation is at 3%. So saving is like a 2% interest, but inflation is higher, the difference of 1% is higher at 3%. So the real purchasing power of your saving is actually declining because the inflation is higher than the interest rate. So the goods you could buy like with that money become more expensive over time, like meaning you effectively lose 1% in purchasing power per year. So in the third one, it would be like the wages and inflation as well. Like people imagine like if the wages goes up, they'll start buying more things. But the higher the wages, the price also skyrocket. So it's still useless in this case. If the wages goes down as well, maybe the goods also, the services might decreases as well, the price. So a quick example of that, like suppose your annual salary is 50k, 50,000 euros, and inflation is at 4%. So if your salary does not increase, like let's say to at least to match the rate of inflation, your purchasing power also will decreases. So if you have like 50,000 euros per annual, your salary per annual per year, and the inflation is just like at 4%, which is high inflation. If your salary like or wages does not increase, like to try to match with the inflation, then your purchasing power also is going to decline, or it's going to decrease, to go down. So in this case, the same 50,000 euros would buy fewer goods and services than it did the previous year. So this will cause really employees to protest, like going to the street and start protesting for salary like increases, or try to increase their wages or salary, because the inflation is higher than the salary which they're getting or in the present moment. So number 4, we're going to touch on the housing market as well, how the inflation can affect the housing market. A quick example of that. So the example will be much better to make you understand. And instead of keeping everything really like logical, we have to try to explore the imaginative side as well. We don't want to keep everything dry on the dry ground. So example of that, the housing market, it will be like inflation can drive up the prices of homes and rent as well, like rental properties. Like if inflation is high and wages does not keep pace, individual may struggle to afford home ownership or to pay their rent as well, as their purchasing power declines relative to housing costs. So if the inflation is high, paying rent become difficult as well, almost impossible, like the living cost also goes up. So the first one is international travel, like traveling abroad. So let's imagine your country has been hit by inflation. You want to travel abroad, maybe using euro, pound or dollars. So try to explore different places as well. So a quick example of that on the international travel. Let's say inflation affects currency exchange rates. So in this case, currency exchange rates, it's like from dollar to euro, euro to pound, or euro to dollar. Something like that's the exchange rates. So try to exchange your currency with another country. So if inflation is higher in one country than another, the purchasing power of that country's currency decreases internationally or decline internationally. The purchasing power goes down as well. So in this case, we're talking like on the international level. So if the inflation is higher, like in your country, or in one country than another, the purchasing power of that country's currency declines, so the money loses its value on the international level. Like for instance, if the inflation in the USA, like United States, is higher than in the Europe, the US's dollar might lose value like relative to euro, because we use euro in Europe. So making international travel more expensive for Americans. So if the Americans are trying to travel from US to Europe, they have to pay more than the previous year if the inflation hits US citizens. So we're going to look at the effects of inflation, like on different economic actors or different sectors. So the first one, let's say the consumers. How can inflation affects consumers? So they're like the buyers. So in this case, inflation is not friendly to consumers or buyers. So as prices rise, consumers can buy less with the same amount of money, as we saw in the previous, like reducing their standard of living unless wages or income rise accordingly. So if the inflation is high, the wages also have to rise, have to be proportional to the inflation to try to be in accordance with the percentage of the inflation. So if it goes down, you will not complain about lower wages. But if the inflation is high, the wages, also the salaries, have to try to rise, like to try to achieve the equilibrium, the balance or the standard. So in the case of businesses as well, how can inflation affect businesses? Like businesses may raise prices, really like to cover increased production cost. So in this case, the production cost is like relative to raw materials. If they're producing raw materials, they're going to, because they are the producers, they have to increase the price as well. In the case of production goods or cost, try to match up with the production cost. Like however, so it's like the quality of a quantity. So however, if consumers cannot afford these high prices, it may lead to reduced sales and profits. So if the consumer will not have enough money or enough income, you're going to see less sales as well. In the case if you're the producer or the seller, and you're going to have less profit because you're having less people who will come to buy your goods and services. So the third example, like in the case of savers, how can inflation affect the savers or the people save money? So it's all about savers. So people holding cash savings, let's say bank accounts or debit or credit cards, are negatively affected by inflation because the value of their savings diminishes over time as well. So if inflation exceeds the interest rate, like on the saving accounts, saving effectively lose money as well. So if the inflation is higher than the interest rate, your saving or the money in your account is going to lose value as well. So in this case, the fourth one is like on the borrowers and the lenders. So if you borrow money, you become a debtor. If you lend money, you become a creditor. So we have debtors versus creditors, borrowers versus lenders. So inflation benefits borrowers or debtors because they repay loans with money that has less purchasing power than when they originally borrowed it. So if you pay when the inflation is higher, you're going to pay less than when you borrowed the money, because the price was higher at that time. Now the price or the money has lost its value. So lenders, however, lose out. So as the real value of the money, they rapidly incline. So because of the real value of the money have declined, if you are a lender or if you are the creditor, in this case, in the case of the inflation, you are the one who's going to lose out. So we're going to look at the hyperinflation as well. So in this case, it's like the extreme cases of inflation, when the inflation is hitting above the 50% amount. That's all about hyperinflation. So it's like the extreme case. So in the extreme cases, hyperinflation occurs when inflation rises unconditionally or controllable. When it cannot be controlled, it keeps skyrocketing really. So often exceeding, let's say, 50% per month. So this leads to a rapid loss of currency value. So the currency loses its value over time, over a short time. So where money can become almost worthless. So losing its value on a very short time span. That's all about hyperinflation. So a quick example as well, just to clear your doubts if you have any. Let's say in Zimbabwe during the 20s, the 2000s, or it happened, the same thing happened as well in Germany during the 1930s as well, when Hitler came to power, rose to power. So the inflation reached millions of % per year in the case of Zimbabwe, and people needed wheelbarrows full of cash to buy goods or to buy basic goods. Let's say a loaf of bread, you need 1,000, whatever currency they use. In the case of Germany, they use French mark. So people needed wheelbarrows to buy just a loaf of bread or something like that. So the government eventually abandoned its currency due to the complete collapse in the purchasing power. So the consumers lost power to purchasing anything. It became even boredom really. In the case, we're going to look at the deflation as well, and the stagflation. So deflation is all about the fear of consumers to buy goods or purchasing goods and services. So in this case, it is like the opposite of inflation. Instead of prices going up, now the price is going below the means. In the case of stagflation, it's all about the high inflation with a stagnant economic growth. That's all about, it's like stagnation and inflation put all together, stagflation. So deflation is like the opposite of inflation. Deflation occurs when the prices decline, when the prices goes down, decreases. While this might seem positive, it can lead to reduced economic activity as consumers delay purchasing or purchases, expecting lower prices in the future. So the consumer is actually delaying to purchase something, expecting that in the future or the near future, the prices are going to drop down. So it's like saving. The fear you really have the fear of purchasing goods or any services. You think the price is going to drop down and in the near future or tomorrow, something like that in the short time. So stagflation also is like a situation where inflation is high, but economic growth is stagnant. So it's blocked or is being held behind. So the inflation is high and the economic growth is being held behind. So there's no any movement in the economic growth. And unemployment also is high in the case of stagflation. So it is difficult to manage because traditional tools like to curb or trigger or change inflation, like raising interest rates. So in this case, interest rates is like the mechanism which government use to increase or to change, to try to affect inflation or in printing money as well. So may worsen employment and slow economic growth. So in the case of interest rates, the central banks, they are the ones to print money. Maybe the government can sell bonds to the central banks and tell them to try to lower the interest rates as well, just to try to get rid of the market crash or the inflation. So what can we say, ladies and gentlemen, in conclusion or in summary about the inflation, the purchasing power of the consumer, going up and rising up and down or skyrocketing, about the wages, salaries, low salaries, high salaries, which one is better? And we have the hyperinflation, we have all about the stagflation, deflation as well. So in summary, ladies and gentlemen, so inflation reduces like purchasing power over time. So inflation affects the purchasing power, making the money lose its value. So making it harder for individuals to maintain their standard of living unless wages or income rise at the same pace as inflation. So in this case, when the standard of living or when the living standard become difficult, like unless wages and the income rises at the same time, trying to match with the inflation. So it is the job or the homework, the task of the government and central banks try to manage inflation to avoid its negative effects, or try to avoid the market crash or market crisis, like using tools like interest rates and the fiscal policy. So in the case of the fiscal policy, it's all about like trying to use like revenue collection and try to have like expenditures or expenses in the case of trying to control the economy. So in the case of interest rate, if you raise the interest rate up, you're discouraging people, let's say from 5% to 10%, you're discouraging people from borrowing. If you decrease the interest rate, then you're encouraging more people to come to borrow. So if the interest rate, let's say, was at 15%, now you lower it down to 5%, now you have more people coming to borrow money at the bank. So the central bank also, the government also can sell bonds to the government. Then the government can print money as well, trying to balance or trying to keep the equilibrium, the nice spot really, in order to control inflation or the market crash. So in this case, like understanding inflation and its impact on the purchasing power helps individuals make informed financial decisions such as saving, investing, and managing expenses or expenditures. So if you understand how inflation works and how it affects the purchasing power, you can understand when to save your money, you can understand when to invest your money, or when to start spending, or how to manage your expenses. Instead of spending more than you earn, you try to manage your expenditures. It's all about like budgeting as well. So ladies and gentlemen, thank you for watching. Don't forget to share, comment, keep your comment coming on business, on the finance, economics. Keep all of them coming. Keep sharing as well, like, comment. And thank you for watching. Have a nice day, ladies and gentlemen. Ciao. Bye.